Michael Wayne. He's Managing Director of Medallion Financial Group. He joined me earlier and began by explaining Medallion's structure and its investment strategy and how he came up with his Cyber Monday selection.
Yeah, so Medallion Financial, we've been around for over 8 years now, and essentially we've got two parts to the business. We've got the private wealth business where we help clients directly invest in the Australian stock market through direct equities. We also use a lot of managed funds and ETFs to gain exposure to other parts of the market, such as international shares and fixed income. And then a couple of years ago, we launched the Medallion Australian Equities Growth Fund, which is a managed fund. And essentially, that is a focus on the Australian markets only. So that's been performing very nicely since inception. But with markets always, you can never have hubris. You can never believe, everything that you hear. You need to be scrupulous at all times. So yeah, the idea is to continue to try and identify high quality businesses, what we like to term as emerging leaders, the businesses that are, still billion-dollar companies today, but have very good balance sheets that can hopefully help them deliver compounded annual growth and turn into the leaders of tomorrow.
All right, so when you take a look, particularly at an Australian company, what do you actually, and particularly also in this current environment, what are you looking for?
Yeah, so we like to look from the top down first, and then we do the bottom up analysis. So essentially what that means is we look to identify certain themes in the economic landscape that are transpiring out there. If you think about, aging population, emerging middle classes, if you think about the need and thirst for data, that helps guide us in the direction where we believe we should be focusing. And then once we identify those sectors that we think, have the best chance of delivering the best returns over the next, 3 to 5 years, we then look for the best quality businesses within those sectors. And that's when we begin the bottom-up analysis. So we like to invest in very high quality businesses. And these are companies that have exhibited consistent revenue growth, consistent earnings growth. We like businesses that have stable or growing return on equities over time, stable or growing margins. We prefer very low debt levels, ideally more cash on the balance sheet than debt. So they're the types of characteristics that we look for within businesses. But then ultimately, you need to make sure that you're not paying too much for those companies. So it's obviously the holy grail of investing, trying to buy quality at an attractive price, which isn't always that easy, but we've shown an ability to be able to do that, and we think that we'll be able to continue to do that going forward. But essentially, when we build our portfolios, we're very agnostic when it comes to market or index weightings. We'll have no hesitation in being overweight certain sectors, and we'll have no hesitation in excluding certain sectors altogether if we think there's not quality on offer in those spaces. So yeah, that's how we go about picking businesses and building our portfolios.
All right, you did mention debt there. We're going to go into that space with the stock that you brought to us today in Credit Corp. It is Australia's largest debt buyer and collector, also has a presence in New Zealand and the US, as well as providing some online consumer finance. What is it about this business that has brought it to your attention?
So Credit Corp's one of those companies which gets really hit very hard in times of market turbulence. So you look back even towards the GFC, Credit Corp sold off significantly. Again, we saw a similar situation play out around COVID. Things started to recover. And then in more recent times, as interest rates moved higher with fears around inflation, Credit Corp's come under significant pressure again. And potentially this is a business that does get treated a little bit unfairly by the market. It has shown itself to be very apt over a large period of time now in being at the peak of its industry. So effectively, Credit Corp is essentially a debt collector. It goes out and it buys debt ledgers, sort of 90 to 180 days in arrears. Effectively, it'll pay an amount for those debts, say 50 cents in the dollar, 30 cents in the dollar in some situations. And the idea is that the team then goes out and collects those debt ledgers and looks to sort of get a return on that money. So yeah, it's actually a very high quality business. It's withstood many different cycles. The key skill, I suppose, with this business is being able to buy debt ledgers at the right time and not overpay for those debt ledgers. It became somewhat more difficult when interest rates approached zero. There was a lot of competition within this space, and that pushed up the prices that many of their competitors, as well as Credit Corp, were paying for those debt ledgers. But now with interest rates, having gone up significantly, the landscape is a lot less competitive. So the debt ledger market is less competitive at the moment, meaning that the pricing on offer is the most attractive that it's been in a number of years. But at the same time, what we've started to see is cash collections or ledger collections has actually started to pick up. So last year, ledger collections was up about 12%. Next year, it's going to be up around 15%. So we think that in this current environment, where interest rates are now starting to peak, if not come down, and the economy is holding up fairly well, we feel as though Credit Corp's in a pretty attractive position to capitalise on that environment.
Well, let's take a bit of a closer look at its key segments then. First, in the US, what are you seeing there, particularly with its debt buying segment? Did see I gather, a 12% increase in its first quarter 25 collections. Did have an issue there with some operational inefficiencies and elevated delinquency levels at the same time. Overall, what sort of growth are you seeing in the US?
Yes, so the US market is a lot larger than the Australian market, naturally. Credit Corp is the dominant player in Australia, however. The Australian market is a lot more mature. The supply levels aren't as great as in the US. So when you turn your attention to the growth driver of Credit Corp, it's really going to have to come from the US market. So the supply numbers, market supply numbers coming out of the US appear very, very good. And the pricing is a lot more attractive. So if you can get annual collections growth up around, 15% or so, then that does bode very well for Credit Corp, particularly as the economy improves or holds steady and interest rates come down. There's no doubt that the last couple of years have been more challenging, just given the economic backdrop. It's no surprise that delinquencies have been a little bit higher. But then when we think about where this cycle's heading, and the pressure starts to come off the consumer, we feel as though that puts Credit Corp in a fairly decent position. And looking at it from a valuation basis, it trades on 12 times earnings. It's trading on a dividend yield of about 4%, which is in line with the market. But the dividend per share growth that's potentially on offer for this company over the next year or two is far in excess of what the market's delivering. So when we look at the valuation picture, we look at the earnings growth picture, and we look at the dividend yield growth picture or dividend per share growth picture, we feel as though it's a fairly compelling opportunity to buy a business that has typically done well as the cycle improves.
Closer to home, what are you seeing with its Australian and New Zealand segments, with its, its core debt buying segments there, and also the pipeline that's coming through?
Yeah, so when you look at Australia, the collections rate has stabilised, which is a positive sign. Collections haven't improved as they have in the US, but I think that's symptomatic of the fact that Australia, like it has with interest rates on the way up and now interest rates on the way down, is somewhat lagging the rest of the world when it comes to this cycle. Whether that's by 6 or 12 months, time will tell, but we do feel as though at some point the Australian cycle will turn, like it has in other parts of the world. So yeah, the Australian market is steady, collection growth is steady. The pricing on offer and supply on offer isn't as great as what's in the US. So we feel as though the main game in town is definitely the US, although the Australian end of the business is holding firm without being spectacular.
And can you tell us a little more about its lending division? I gather it's got what it calls a Wallet Wizard product. Have you taken a look at that? What's that adding to the business?
Yeah, so Wallet Wizard is that lending arm. Basically, it lends mainly for fast car loans, essentially. So that's a part of the business, but it's not really the main attraction for us. It is a decent growth driver for them, but obviously, as you can imagine, the new car market is under a little bit of pressure at the moment, given the conditions that are around. However, the used car sales market is still very strong, and obviously a lot of people require loans for used cars as well as new cars. But the way we would sort of see this business and looking at the major contributors to revenue, it's very much a debt collection business with Wallet Wizard there as a small but growing part of the company.
And Michael, what have we heard from management in terms of guidance?
Yeah, so they came out with an update only a few weeks ago, and that update was pretty good. It sort of just reaffirmed the outlook for the business over the next sort of six to 12 months or so. Management obviously haven't been getting overly excited, just given that the cycle is just beginning to turn. But they just reiterated essentially that the business is on track to achieve the guidance that was sort of outlined back in August.
All right. I'm just noticing, looking at a couple of the broker ratings on the stocks, Macquarie's got a target price of 19. Actually, it's taken, 19.62 up from $18. What's your view? Do you have a target in mind or not?
Yeah, obviously we're not as fixated on a precise dollar figure. However, we do see this company, recovering back towards, the highs achieved a few years ago. We certainly think it's conceivable that if this company can deliver on its forecast coming into the February earnings season, that the price can push, above 20. At the moment, we've got a bit of a floating price target there of around $23, but obviously those numbers change as updates from the company are forthcoming. This is a company that does report or update quarterly, so it does give the investors a pretty good line of sight for how things are tracking. But yeah, so I think that $23 is reasonable, particularly if they can come in slightly above expectations in February.